Silver is hovering around $95 per ounce. Just 12 months ago, it was trading at $30. That's a 215% gain in 1 year. If you're holding silver right now, you're probably asking yourself the same question thousands of other investors are asking. Should I sell? Should I take these massive profits? Or is there more room to run? Here's what most people won't tell you. The answer isn't about the price, it's about the signal. And by the end of this video, you'll know exactly what that signal is, why it matters, and how to use it to protect your wealth while maximizing your returns. Let me start with the headline everyone's talking about. Silver just did something it hasn't done since 1980. It broke through its all-time high. We're not talking about inflation-adjusted numbers. We're talking about the actual nominal price. $64 was the old record from 45 years ago. We blew past that in December 2025, and now we're pushing toward $100. But here's where it gets interesting. Back in 2025, silver started the year at $29. By December, it hit $70. That's a 143% surge. Gold, for comparison, gained 64%. Platinum gained 137%. But silver? Silver was the leader of the pack. Now I want you to understand why this happened, because understanding the why is critical to knowing when to sell. This wasn't just a speculative bubble. This was fundamentals meeting reality in the most dramatic way possible. Let's talk about supply and demand. For 5 consecutive years now, the silver market has been in a structural deficit. That means global demand has exceeded mine supply every single year since 2021. In 2025 alone, the deficit was estimated at 95 million ounces. That's almost 3,000 tons of silver that the market needed but couldn't produce. Over the past 5 years, the cumulative deficit has reached 820 million ounces. Think about that for a second. 820 million ounces of silver that people wanted to buy but couldn't get from mines. Where did that silver come from? It came from above-ground stockpiles. It came from exchange inventories. It came from recycling. And those sources are running dry. Global silver mine production peaked back in 2016 at around 900 million ounces. By 2025, production had fallen to approximately 835 million ounces. Meanwhile, demand reached 1.2 billion ounces. The math doesn't work. The gap is widening. Here's what's driving that demand. Industrial use now accounts for more than half of global silver consumption. Solar panels alone consumed over 25% of annual supply in 2024, and that number increased again in 2025. The Silver Institute projects that solar demand will nearly double between 2020 and 2030. By 2050, cumulative solar demand could equal 85 to 98% of today's known silver reserves. But it's not just solar. Electric vehicles use silver in their battery systems, power electronics, and charging infrastructure. The explosion in EV production means more silver is being pulled into the automotive sector every year. Then you have artificial intelligence data centers, which require massive amounts of silver for their advanced semiconductor chips and high-performance computing systems. Every technological advancement we're making is silver-intensive. Now let's add another layer, investment demand. In 2025, silver exchange-traded products saw inflows of 187 million ounces. That's an 18% increase year over year. Investors aren't just buying silver for speculation. They're buying it as a hedge against inflation, currency debasement, and geopolitical instability. The COMEX and LBMA silver inventories both drew down significantly through 2024 and 2025. Available good delivery bars tightened to the point where lease rates spiked and premiums exploded. In China, physical silver premiums hit levels not seen in years. The physical market was sending a clear message. There isn't enough silver to go around. Here's where most analysts get it wrong. They assume that high prices will solve the supply problem. They think miners will just produce more silver and the deficit will disappear. But that's not how silver works. Approximately 71% of mined silver comes as a byproduct of other metals like copper, gold, zinc, and lead. Silver production doesn't respond to silver prices. It responds to copper prices, gold prices, and zinc prices. Even if silver hits $150 per ounce, a copper mine won't suddenly double production just for the silver byproduct. The economics don't work that way. Mining companies optimize for the primary metal, not the byproduct. This creates a structural supply constraint that can't be easily fixed. And here's the kicker. It takes 5 to 7 years to develop a new mine. Even if companies started investing heavily in new silver projects today, those mines wouldn't come online until 2030 or later. The supply deficit isn't going away anytime soon. Let me give you a real-world example of what's happening right now. Bullion Star, one of the major precious metals dealers, reported in January 2026 that replenishing silver inventory has become increasingly challenging. They've had to adjust their premiums significantly. Their good delivery silver bars are now selling at spot plus 6%. 1 kilogram bars are at spot plus 14%. 1 ounce coins are at spot plus 12%. Those premiums tell you everything you need to know about the physical market. When dealers have to pay more to acquire silver and wait longer for delivery, it means the physical shortage is real. It's not just a paper market phenomenon. It's happening in the real world where actual metal changes hands. Now let's talk about what happened in late 2025 and early 2026 that pushed silver to these record levels. On January 20th, 2026, silver jumped more than 5% in a single day to hit a new all-time high above $94. What triggered that move? President Trump threatened to impose new tariffs on 8 European nations in a bid to gain control of Greenland. Geopolitical tensions spiked and investors rushed into safe haven assets. But here's what's interesting. Earlier that same week, the Trump administration decided not to impose tariffs on critical minerals, including silver. Silver is now on the U.S. critical minerals list because of its essential role in green energy technologies and electronics. That decision actually caused silver to pull back initially because some traders thought it removed a catalyst. But the pullback was short-lived. The underlying fundamentals were too strong. What we saw in that price action was classic technical behavior. Silver hit $94, pulled back to the high 80s, then resumed its climb. That's healthy consolidation. That's what a sustainable bull market looks like. It's not a straight lineup. There are pauses, corrections, and moments of profit-taking, but as long as the support levels hold, the trend remains intact. So let's talk about those support and resistance levels, because this is where we start to build your exit strategy. Technical analysts are watching several key levels right now. On the downside, support sits around $80, then $70, and then $65. Those are the areas where buyers have consistently stepped in during pullbacks. On the upside, we're in uncharted territory. There's no historical resistance because we've never been here before. The next psychological level is $100. If silver breaks through 100 convincingly, the next targets are $105 based on Fibonacci extensions, then potentially $120 to $150 if momentum continues. Here's what the technical indicators are telling us right now. The Relative Strength Index, or RSI, is showing readings above 70 on multiple time frames. When RSI goes above 70, it means the market is overbought. That doesn't necessarily mean it's time to sell immediately. It means the market is extended and due for a breather. During strong bull markets, RSI can stay overbought for weeks or even months, but it's a warning sign that you need to pay attention to. The MACD indicator is also showing some concerning signals. MACD measures momentum, and right now it's showing potential negative divergence on some time frames. Negative divergence happens when the price makes a new high, but the MACD doesn't confirm that high. It suggests that momentum is weakening even as price continues to rise. That's often a precursor to a correction. Moving averages tell a different story. Silver is trading well above its 10-day, 20-day, 50-day, 100-day, and 200-day moving averages. All of those averages are sloping upward. That's a classic sign of a strong uptrend. As long as silver stays above those moving averages, especially the 200-day, the long-term trend is still bullish. So here's the question. If the fundamentals are strong, the supply deficit is real, industrial demand is growing, and the long-term trend is intact, why would you ever sell? Let me give you the signal you've been waiting for. The signal to sell isn't a single price target. It's not when silver hits $100 or $150. The signal is a combination of 3 things happening simultaneously. You need to see all 3 before you consider taking substantial profits off the table. Signal number 1. A confirmed break below major support with increased volume. If silver breaks below $80 per ounce and holds below that level for more than 3 days with rising selling volume, that's your first warning. If it then breaks $70 with the same pattern, that's a major technical breakdown. The bull market structure would be damaged, and a deeper correction would be likely. Signal number 2. a significant shift in the fundamental narrative. This means either the supply deficit narrows substantially or industrial demand starts to decline. The Silver Institute would need to report that mine production is increasing significantly or that solar panel manufacturers have found a cheaper substitute for silver. As of right now, neither of those things is happening, but if they do, the fundamental thesis changes. Signal number 3. RSI divergence combined with MACD bearish crossover on the weekly time frame. This is the technical confirmation that momentum has truly shifted. When RSI makes a lower high, while price makes a higher high on the weekly chart, and MACD crosses below its signal line while both are above zero, that's a high probability signal that a major top is forming. You need all three signals, not one, not two, all three. Why? Because in a structural bull market driven by real supply and demand imbalances, temporary corrections are normal. You don't want to sell on a temporary dip and miss the next leg higher. But when all three signals align, the risk-reward shifts dramatically in favor of taking profits. Let me give you a historical example. In 2011, silver reached $49 per ounce. That was the previous modern peak before the recent surge. If you were holding silver in April 2011, what signals would have told you to sell? First, silver had gone parabolic. It rose from $18 to $49 in less than 6 months. That's a 172% move in half a year. The RSI on the weekly chart was above 80, which is extremely overbought. Second, industrial demand was starting to soften as the global economy recovered from the 2008 financial crisis. Central banks were signaling that interest rates would start to rise. Third, silver broke below its 50-day moving average with huge volume and didn't recover. That was the technical confirmation. If you had waited for all three signals in 2011, you would have sold somewhere between $42 and $44. Silver then proceeded to crash all the way down to $14 over the next few years. The people who sold at $42 protected their wealth. The people who held thinking silver would go to $100 lost over 70% of their investment. I'm not saying we're at that point now. The setup today is very different from 2011. Back then, the supply deficit wasn't structural. Industrial demand was cyclical, not secular. The world wasn't electrifying its transportation system or building AI data centers. But the lesson remains. You need a clear exit strategy based on objective signals, not hope or fear. Now let's talk about profit-taking strategies. Even if you don't see all three sell signals, that doesn't mean you should do nothing. There are smart ways to manage your position that protect profits while maintaining upside exposure. Strategy 1 is the scale-out approach. If silver continues to run higher, consider selling 10 to 20% of your position at key psychological levels. Sell 10% at $100. Sell another 10% at $125. Sell another 10% at $150. This way, you're locking in profits along the way, but you're not abandoning your position entirely. If silver keeps running, you still benefit. If it reverses, you've protected a portion of your gains. Strategy 2 is the rebalancing approach. If silver has grown to represent more than 15 to 20% of your total portfolio, it makes sense to trim it back down regardless of whether you see sell signals. This isn't market timing, it's risk management. You don't want any single asset dominating your portfolio, no matter how bullish you are on it. Strategy 3 is the ratio trade. Watch the gold to silver ratio. Historically, this ratio averages around 60 to 70 ounces of silver to 1 ounce of gold. Right now, the ratio is around 70 to 82. If that ratio drops below 60, it means silver is outperforming gold significantly. That could be a sign that silver is getting ahead of itself. You could sell some silver and buy gold to lock in that relative performance. Strategy 4 is the cost basis approach. Calculate your original cost basis and sell enough to recover your initial investment once you've doubled or tripled your money. For example, if you bought silver at $25 and it's now at $75, you've tripled your money. Sell 1/3 of your position to get your original investment back. Now you're playing with house money. The remaining 2/3 is pure profit, and you can let it ride without psychological stress. Let me address the elephant in the room. What if silver goes to $200 and you sold at $100? How will you feel? The answer is, you'll feel just fine if you followed a disciplined strategy. Investing isn't about catching the absolute top. It's about consistently making good decisions based on the information available at the time. Think of it this way. If you bought silver at $30 and you sell half your position at $100, you've locked in a 233% gain on that half. If silver goes to 200, you still have the other half that gained 567%. Your blended return is still extraordinary. And if silver crashes back to $50, you protected half your wealth at $100, while the other half only pulled back to a 67% gain from your cost basis. Either way, you win. The key is to avoid the two extremes, selling everything too early or holding everything too long. Both are emotional decisions driven by fear and greed. The right approach is systematic, disciplined, and based on objective criteria. Now let's talk about what could go wrong. What are the risks to this silver bull market? Because understanding the risks is just as important as understanding the opportunity. Risk number 1, a sudden unexpected resolution to geopolitical tensions. If the Trump tariff situation resolves peacefully, if tensions in the Middle East calm down, if U.S.-China relations improve dramatically, the safe haven bid for silver could diminish. That doesn't kill the bull market, but it could slow it down or cause a correction. Risk number 2, a spike in real interest rates. Silver is a non-yielding asset. It doesn't pay dividends or interest. When real interest rates rise, meaning interest rates adjusted for inflation, the opportunity cost of holding silver increases. If the Federal Reserve decides to hold rates higher for longer, or if inflation falls faster than expected, real rates could spike. That would pressure silver prices. Risk number 3, technological substitution. If scientists develop a cheaper alternative to silver for solar panels or electronics, industrial demand could fall. Right now, there's no viable substitute that matches silver's conductivity, durability, and efficiency. But technology advances quickly. This is a long-term risk, not an immediate one, but it's worth monitoring. Risk number 4, recession. If the global economy slips into a severe recession, industrial demand for silver could decline significantly. Manufacturing activity would slow, solar panel installations would decrease, EV production would fall. Yes, investment demand might increase as a safe haven, but the net effect could still be negative for silver prices in the short term. Risk number 5, a major new silver discovery or mine coming online. If a company discovers a massive new silver deposit and brings it into production quickly, it could ease the supply deficit. Again, this is unlikely in the short term because of development timelines, but it's a possibility to keep in mind. None of these risks are imminent, but they exist, and they're the reasons why you need an exit strategy. You can't just buy and hope. You need to monitor the situation constantly and adjust your position as conditions change. Let me give you some practical steps you can take right now. First, set up price alerts on your phone or trading platform. Set an alert for $80 on the downside. That's your first support level to watch. Set an alert for $100 on the upside. That's your first psychological resistance level. When these alerts trigger, take a few minutes to analyze the market and review your strategy. Second, follow the Silver Institute's quarterly reports. They publish detailed data on supply, demand, and inventory levels. If you see the deficit narrowing or inventories rebuilding, that's valuable information. You can find these reports on their website for free. Third, track the gold to silver ratio weekly. It's a simple calculation. Divide the gold price by the silver price. If the ratio drops below 60, it's a sign that silver might be getting overextended relative to gold. If the ratio rises above 90, it's a sign that silver might be undervalued relative to gold. Fourth, monitor technical indicators on at least a weekly time frame. Don't obsess over daily movements. They're too noisy, but once a week, check the RSI, MACD, and moving averages on the weekly chart. Look for divergences, crossovers, and trend changes. When you see warning signs developing, take them seriously. Fifth, keep a trading journal. Write down why you bought silver in the first place. Write down your price targets, your exit signals, and your reasoning. Review this journal regularly. It will help you stay disciplined and avoid making emotional decisions when the market gets volatile. Here's something most people don't understand about this silver bull market. This isn't just a price story, it's a structural transformation story. The world is electrifying, the world is decarbonizing, the world is digitizing. Every single one of those trends requires massive amounts of silver. This isn't a temporary phenomenon. This is a decade-long shift. The International Energy Agency projects that global solar capacity will quadruple by 2030. China, the US, Europe, and India are all building out renewable energy infrastructure at unprecedented scale. Each megawatt of solar capacity requires between 50 to 100 grams of silver. Do the math. Millions of megawatts times 100 grams equals billions of ounces of additional silver demand over the next decade. Electric vehicles are another secular trend. There are roughly 15 million EVs on the road today. By 2030, projections suggest there will be 100 million. Each EV uses between 25 to 50 grams of silver, depending on the model. Again, do the math. The demand curve is pointing straight up. The artificial intelligence boom is adding another layer of demand that most analysts are underestimating. AI data centers require cutting-edge semiconductors built on advanced nodes. These chips use more silver per unit than traditional chips because of higher conductivity requirements at smaller scales. As AI infrastructure expands globally, silver demand from this sector will grow exponentially. Here's what all of this means for you as an investor. You're not riding a speculative bubble, you're riding a fundamental transformation of the global economy. Speculative bubbles pop when reality doesn't match expectations. Fundamental transformations compound when reality exceeds expectations. That's why the signal to sell isn't a price target. It's a change in the fundamental narrative combined with technical confirmation. Until the supply deficit closes, until industrial demand plateaus, until the physical market shows signs of loosening, the fundamental thesis remains intact. Add on top of that the technical confirmation of a trend reversal, and then you have your sell signal. One more thing I want to address. Some of you might be thinking, what about a dollar collapse? What if silver goes to $500 or $1,000 because the currency system breaks down? This is a legitimate scenario that some precious metals investors prepare for. If you're holding silver primarily as insurance against currency collapse rather than as a profit-generating investment, your exit strategy will be different. In a currency collapse scenario, you don't sell silver for dollars. You hold silver and use it as money or trade it for real assets like land, food, or other necessities. The sell signals I've outlined in this video assume you're treating silver as an investment that you eventually want to convert back into dollars or other assets. If you're treating silver as endgame insurance, you may never sell. You hold until the system resets and then use your silver as capital in the new system. That's a personal decision based on your worldview and risk tolerance. There's no wrong answer, but you need to be clear with yourself about which game you're playing. Are you investing for profit or are you preparing for collapse? The answer will determine your entire strategy. Let me bring this all together with a clear action plan. If you own silver right now, here's what you do. First, decide what percentage of your portfolio you're comfortable having in silver. If it's grown beyond that percentage because of price appreciation, rebalance back down to your target. Sell the excess and either take cash or rotate into other assets. Second, set your three-part exit signal. Decide in advance what technical break level, what fundamental change, and what indicator divergence would cause you to sell. Write it down. Make it concrete. Don't leave it vague. Third, implement a scale-out plan for the portion of your silver that you're willing to trade. If you have 100 ounces, decide that 70 ounces is your core long-term hold and 30 ounces is your trading position. Scale out of those 30 ounces at predetermined levels. Fourth, stay informed but don't overtrade. Check the market once a week, not once an hour. Read the quarterly Silver Institute reports. Follow a few trusted analysts. But don't let short-term volatility shake you out of a long-term position. Fifth, prepare for volatility. Silver is going to have 30 to 40% corrections even in a bull market. That's normal. If silver drops from $100 to $70, that's a 30% correction, not the end of the bull market. As long as your three-part sell signal hasn't triggered, corrections are buying opportunities, not selling opportunities. Let me give you the bottom line. Silver is in a structural bull market driven by supply deficits and industrial demand growth. The price has already more than tripled from its lows, and it's at all-time highs. That doesn't mean it can't go higher. In fact, many analysts are projecting targets of $150 to $200 per ounce over the next 1 to 2 years. But it also doesn't mean you should blindly hold forever. You need an exit strategy. That strategy isn't based on a single price target. It's based on the three-part signal, technical breakdown below major support, fundamental narrative shift, and momentum indicator confirmation. When you see all three, it's time to take substantial profits. Until then, use smart position management, scale out at key levels, rebalance when silver becomes too large a portion of your portfolio, lock in your cost basis once you've doubled or tripled, let the rest ride with a clear exit plan in place. The silver bull market isn't over, but it also won't last forever. Markets never do. Your job as an investor is to participate in the trend while it's intact and protect your profits when it reverses. The signal I've given you today will help you do exactly that.